Yeah, you're welcome back to your Global Business Report. Earlier, we listened to the Central Bank Governor on the monetary policy meeting decisions today. Joining me now to discuss this a bit further is Tilewa Adebajo, who is the CEO of a CFG Advisory, to discuss these issues a little bit further. Thank you so much. It's happy to see you in the new year 2022. So you're coming in on a very big day with the monetary policy rates all being all parameters on hold. But if we start from the externalities, looking at the U.S. Rate hike impact on Nigeria, what do you think the FOMC will decide tomorrow? That's the U.S. Fed. And do you think it will have implications for us?
Well, I think the direct implication for the increase in the rates by the Federal Reserve Bank of the United States will impact more of our Eurobond funding. Because most of the World Bank and the IMF funding we have is more development finance. And they attract lower interest rates. But the Eurobonds, which have been very active in the Eurobond market, will now begin to attract higher interest rates. And of course, the investors are going to be pleased with that because the yields on those bonds will be higher. But on the negative side, for the Treasury and the Federal Ministry of Finance, we're going to have to pay more in debt service. And we're planning to fund, we have a 6 trillion naira deficit this year, and we're funding half of that deficit on the Eurobond market. So clearly that funding exercise is going to be more expensive. And as you know, debt service is already taking about 95% of our revenues and is the second line item on our budget behind defense spending. So this is going to go up more. And it's going to put more pressure on our revenue streams. So that's the direct impact that I see. The secondary impact is the fact that because interest rates are a lot higher offshore now, you can begin to see disintermediation in the sense that emerging markets might not be as attractive as before, and the hike in US rates and the risk factor will probably, investors might favor going into more of the bonds in their own markets as opposed to emerging markets.
Where does that leave Nigeria and other emerging and frontier markets in Africa, for example, in terms of what's the positive side, if any, of what is happening in the wider market of the US and the Europe?
Well, what it just means is that we need to restructure our economies. Our economies still remain competitive in terms of the low labor costs. You can see what has happened in China. China has done a record 700 billion trade financing surplus. The trade surplus is 700 billion, which is a record high for them. And they're managing that very well, and they're adjusting because they continue to manage their foreign exchange and their interest rates to be able to ensure that their goods are competitive for exports.
So in terms of the inflation consideration for the monetary policy, there's a whole bit there to consider. You have inflation, you have the FX. But give us a few minutes, Tilewa. Let's just take a listen to the Central Bank Governor very quickly for some of his words, what he just said, just within the hour. Let us take that very quickly, then we'll come back to you.
The MPC observed with concern the moderate rise in inflation in December 2021, noting that this was typical of increased aggregate demand associated with the end of the year festive activities. Members, however, expressed their continued commitment to drive down domestic prices by putting in place relevant policy measures to curb the rise in inflationary pressures while also supporting the fragile recovery. In its determination as to whether to hold or loosen or tighten its policy stance, MPC was mindful that whereas the US and some advanced economies have signaled their intention to commence policy normalization, which may result in capital flow reversals for the emerging market and developing economies, the major focus of these climbs were targeted mainly at reining in the high level of inflation which had been unprecedented in the last 4 decades in those climes. For Nigeria, members were of the view that Nigeria is confronted by not only inflation but also fragile output. As a result, MPC believes that its current stance of price and monetary stability, conducive for growth, remain desirable. The MPC is convinced that various measures being implemented were helping not in boosting output growth, but also in moderating inflation. MPC therefore enjoined management to continue to use its development finance tools to accelerate output growth, which would also help in boosting manufacturing output that would ultimately help in moderating prices. It also requested management to continue its use of administrative measures, including discretionary tools at its disposal through the CRL to control money supply in the economy. In its final consideration, the committee was clear that a loosening option was not desirable because it would trigger further liquidity surfeit and fuel inflationary pressure, as available funds may outstrip the economy's absorptive capacity or domestic capacity utilization. It also feels loosening could trigger foreign exchange demand pressure, as the excess liquidity will be channeled to either frivolous importations or speculative holding of foreign exchange as alternative investment channels narrow, leading to foreign exchange depreciation and or inflation. MPC also dropped a tightening option at this meeting in view of the fragile state of the current gross domestic product growth rate and potential external and domestic headwinds confronting the economy. MPC also feels that tightening could truncate the steady improvement in credit performance, including other financial soundness indicators, and reverse the declining trend in NPLs. Moreover, MPC feels tightening could counteract the CBN's credit expansion motive as a necessary condition for improved economic growth and employment generation. The MPC therefore concluded that a hold stance remains desirable at this time, as this would indicate a conservative but cautious and consistent policy choice given the prevailing economic conditions and outlook, thus strengthening the policy credibility and focus. It also feels that a hold would signal MPC's realization of the fragility of the growth recovery and its sensitivity to emerging global and domestic uncertainties, hence the need to sustain policy trajectory. After a careful balancing of the benefits and downside risks of each policy option, MPC decided to hold all policy parameters constant, believing that a hold stance will enable the continued permeation of current policy measures in supporting the recorded growth recovery and further boost production and productivity, which would ultimately rein in inflation in the short to medium term. The committee thus decided by a unanimous vote to retain monetary policy MPR at 11.5%. In summary, MPC voted to retain 1. MPR at 11.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%.
Yeah, the governor of the central bank, they're going to be Philip. Tilewa, just a quick one. So this inflation, the Minister of Finance talked about it as part of the decisions to keep the fingers off the petrol subsidy button. What's your take on that, quickly?
Well, it's interesting because we need to understand the inflation that happened in the last quarter the central bank governor was talking about. Normally, the inflation we have is cost push, which is food prices, and what you're talking about, the impending or the subsidy prices would have had an impact. We're looking at price-driven, cost push. But over Christmas, he said that the problem of inflation, which they felt was one-off, was as a reminder of demand pull, which was aggregate demand, increasing. So, which is quite interesting, that it was a demand pull factor of inflation that was from last year. And I think that's very important because this is quite significant because that sort of inflation is actually quite beneficial, consumer spending. It's a very good boost to economic growth and activity if you can manage that. But we're beginning to see signs of that, but they clearly said that was one-off because it was during the festive period. And aggregate spending and aggregate consumption will return to normal this year. But yes, the question about the fuel subsidy, I think we need to understand very carefully, is that what impact will the increase in fuel prices how will that begin to spike inflation once again? And I think that is a big subject, and I think we're not quite sure what happened. But if you talk about the subsidy, you know, what I've always maintained and the advice I've always given government is that at the beginning of this administration, if they had taken the subsidy of maybe 10% every year, 10% every year, and then you do it gradually over a period of time, not only would we not feel it, we would not notice it, but eventually the system would not have that shock of wanting to remove the subsidy. And the question was even, why don't we just even remove maybe 30% instead of going for 100%?
Interesting development, but again, it's been the start of the year. Tilewa Adebajo, quite a whole lot. We're speaking, the International Monetary Fund is presenting its global economic outlook for the current year. Stand by. Global economic outlook, going to right now to the IMF. For the chief economist, Gita Gopinath, has been doing a briefing and also taking questions from journalists from around the world. Let's take a quick listen, everyone.
Trade come back very strongly. It's also a reflection of the fact that global demand has shifted more towards goods away from services, and that also helped trigger a lot of trade. So if you, I mean, in the third quarter of last year, you know, towards the end of it, there were problems in terms of disruptions, Delta disruptions, but more supply chain disruptions that were affecting trade. But most recently, we're seeing some of that get ironed out, and we're seeing recoveries on trade. But I think looking forward, we should keep in mind that as things normalize and as demand starts pivoting back to services away from goods, we should also see some reduction in this. We should expect to see some slowing in the growth in trade. So I would say these are the combinations of factors.
That's a briefing currently going on, that's live from the International Monetary Fund in Washington. Gita Gopinath, who is the chief economist of the International Monetary Fund, is leaving that position, of course, moving to another position within the IMF. But of course, this very important review comes in right now. Update: global economic growth is expected to slow down from 5.9% last year to about 4.4% in 2022, which is half a percentage point lower for 2022 than in October. World Economic Outlook, which the IMF released, the drop likely reflects forecast markdowns in the two largest economies in the United States, the pandemic in China. Then, of course, the IMF still projects Nigeria's 2022 to grow 2.7%, which is unchanged from the IMF's position last October. Tilewa Adebajo of CFG is here, the CEO, CFG Advisory. Tilewa, this is quite interesting that Nigeria, you just touching on 2.8, which the central bank talked about, the World Bank. Now the IMF retaining the 2.7% with the first subsidy issue and the whole interest rate on hold to start the new year. You think we're on trajectory for what the central bank is confident about, that the growth is beginning to happen despite it being soft?
Well, it's interesting to add to that. The Federal Ministry of Finance and the federal government is actually projecting 4.4% growth too. So
you think that's more ambitious?
No, well, it is ambitious, but it's interesting, and I think it's positive that there is a focus on growth. And that is why I'm very happy about this pronouncement for monetary policy. There's a sensitivity and there's a realization that growth is very important in this time of the economy to drive. They need to sustain that growth because growth and sustaining growth is the only way out of the current predicament we have with about 100 million people in poverty, the levels of unemployment. 6-7% growth per annum will solve a lot of problems in Nigeria today. And so it's important that we sustain the fragile growth that we have. The central bank, I think monetary policy has reached its limit. I think the central bank has done what it needs to do. It's doing more with intervention funds and a lot of other things they're doing on the side. But the big elephant in the room really is the fiscal side. There's a serious need for fiscal restructuring. You mentioned the subsidies, revenue challenges. Despite the fact that oil is now closing on $90 a barrel, we are not able to meet our quotas because our production is falling short of our quotas. So that means that there is a potential loss of revenue for us in that. And those are the issues that we really need to address frontally.
In terms of what would the factors will be before the MPC in the month of March, what will likely change between now and the end and the third month of the year?
Well, what I expect to see right now is that with the monetary policy holding these rates the way they have, I think we should begin to see more significant activity in the areas of growth. What I would like to also say is the fact that if you understand that last year we had about 3 unicorns in Nigeria, and we had about close to $1.5 billion of funds coming in for startups. $4 billion came into the whole of Africa, 1.5 billion came into Nigeria. That's significant. We're expecting that amount of money to go into $2 billion this year. We have close to between $25 to $30 billion of remittances from diaspora. It's important for us to continue to improve these flows to be able to stimulate growth in our economy. Because despite or in spite of the government policies, investments and things are going on around this country. So we need to sustain that momentum to be able to achieve the growth. The PMIs are looking quite positive. We're all recovering globally from the COVID pandemic, and the global economy is more or less returning to normal. And I think if we can sustain these policies over the next 3 months, we should begin to reap the benefits.
Quite a lot happening out there. Tilewa Adebajo, CEO at CFG Advisory.